All right, hey everyone, Brian Ferguson here, Fergmar Capital. I have Clayton Garner who with us today. We're going to walk through just kind of our stress test analysis, how we come to it. It's a form you'll see in our offering memorandum. So just wanted to walk you through it and kind of give you a little insight on how we put this together and our thought process on it. So I'm going to share my screen here with you all. Okay, so this is the format. It's a tab inside our underwriting model. And what we do is we try to do a few different things. The as modeled here is what you see obviously inside there. Those are our projections. Now, why those projections do have some conservative factors, for instance, 88% economic occupancy. That's on the conservative side. It's less than our portfolio in that same market does, and it's less than any of the comps would tell you. But we take it a step further and we want to show you what could happen if some of these other assumptions get worse, what could happen if they get better. And then we try to break down what does it take to break even. We get asked that a lot, and we know it's an important question. Like, what has to happen in the deal for me to just break even and at least get my money back? So we're just going to talk through some of this, and then if anybody has any questions after the review it, please reach out. So we factor a few different assumptions here. You take rent growth, our expense growth, the exit cap rate, which is a huge one, our economic occupancy. Pretty important to note there, we don't focus on physical occupancy. We focus on economic. We don't care how many beds are in how many heads are in beds there. It's more so what we're actually collecting. This is the interest rate of the deal, refi. This deal particularly has a refi factored throughout the hold period. So we talk about that. And then the LTV. So we'll just kind of walk through this scenario here. The as modeled on the deal, and this was for the 70-30 split on this section on the Grove offering, was coming in at a 2.25 equity multiple and a 22.83% IRR. If you come over here to our worst case scenario, if we saw zero revenue growth the entire hold period, it would drop your projections to a 1.71, 15.61 IRR. And then you can see if expense growth went from 2% as modeled here to 5%, you can see what it drops it, and so on and so on. You will see some interesting notes here as you get towards the bottom. If the refinance LTV dropped, which means we are going to get less proceeds when we do the refinance at year 3 in this scenario. It's interesting, your equity multiple actually increases, but your IRR drops. And that's because you now have more capital in the deal, getting that preferred return rate on it. But the time it took to get your money goes down, so your IRR drops, but your equity multiple went up. So we test multiple scenarios there. These lines are what happens on an individual basis. If revenue growth happens, this is what happens. And these are all individual. And then the bottom is a range of what happens if all these things happen. So kind of if you jump over to best case, same thing there. This is what happened if some things go better. If we could see a 6%, revenue growth. If we didn't see expense increase, if we were able to see a little bit more of a compressed cap rate, if our economic occupancy happened, and you'll see what those things do individually. And then again, here is the average of what happens. We could go from a 2.25 up to a 2.84. IRR could go from a 23 to say a 28. So same range is there, and that's how we put that together. And then we added this one in. We didn't used to have this one in ours, but we started adding this in, this break even. So now this bottom is a cumulative of all these things. If we saw a less than 1% revenue growth, if we saw expense growth go from 2 to 4.5, cap rate go from 6.5 up to 7.5, our economic occupancy went down to 85%. Our interest rate increased at the initial period. This is on day one, so that'd be pretty easy to control. You're proceeding with the deal knowing it's happening. Our refinance rate goes up and our LTV goes down. If all those things happen, this perfect storm of all these things happening, then you're at a 1. You're at a 1x. That means if you had put 100,000 in and all these things go bad, when we exited, you get 100,000 back. So wouldn't always see that in a deal. This deal particularly that we're showcasing on is an extremely strong deal with an extremely low basis going in. So a lot of things can go bad, and so we can still return all the capital. Like I said, that wouldn't always be the case there. So we just wanted to walk through this. Clayton, you got any certain pieces you want to tie into? Maybe just talk a little bit about how some of this is put together.
Yeah, sure. So, I mean, I think the thing that's kind of interesting against a normal stress test, and something you see outside of something you don't see in most institutional models, is going to be the purely NOI based stress test. We did those for a couple of years, and While they work, they don't really paint the picture of, I think, the volatility of certain market conditions. And we commonly got, the individual hits on, okay, well, that's great, but what if the exit cap alone is a problem? So this takes quite a bit more time. As you can see, like these are not formulas individually. We have to run each of these analyses individually every time a metric changes. And we do that just so we have a clear range. And it also gives us as operators, obviously, a good picture in our head as well of what each of these factors actually have. As you can see, some of the things like, expense growth, that would be something that immediately I think most people would go, oh, expenses are higher than ever and they keep getting worse. What does that do? Well, you can see it's actually one of the least impactful things on the deal. So, I mean, it gives you a good, I guess, high level visibility to each individual condition rather than just saying, oh, well, if it underperforms by 10%, what does that look like for you? So,
Yeah, absolutely. I mean, just for context, I guess for anyone watching it, you mentioned how many different models and the changes it does, and I know what that means, but just how many models do you have to make and put together to get this what looks like a easy sheet?
well, so as you can see, the as model portion obviously is just giving the current model details. That part's set for us. That's using our current assumptions. For each of the other models, we have to actually look at, what each of those factors is in reason of. Like we won't say revenue growth is going to be a range of 0 to 30% because that's not realistic. But we try to stay within a limited range of the factors we have on the specific deal. And then for each one of those deals, we actually have to model. So for revenue growth, we actually have to build the model to show revenue growth is zero, leaving everything else the same to get those metrics and see what they look like. And so for each one of those lines, that has to happen. So to give some context, let's say we have a new T12 come in that changes some occupancy statistics, right before, the deal's funded. Well, we need to go in and change that one metric, which would change the as model column, and then continue to run the models for each of the other scenarios to get this span. So it's quite a time-consuming process, but it's the only way to get that full span. And then on the break even is kind of a mixture of honestly just playing with, where we think the ranges could go altogether. Obviously, if you hit the deal for every worst case scenario, the deal just won't return capital. That would be true in I think 99.9% of deals. If you assume the worst in every single thing, I don't know if there's a way to return your money on it. But what we can do is go, okay, what is a reasonable assumption of the worst things can happen at the same time? We see expenses go up, we see occupancy go down, refinance interest rates, do what they did back in 22, 23, and they kind of skyrocket. What does that look like for the deal with some reason to actually give you a return of capital? So that has to be done as well each time we make an adjustment to the model. So quite some time put into just to have the right numbers and to make sure that we have a good visibility of it.
Awesome. Yeah. So, again, it looks like just a quick one-page sheet. We have this in our offering memorandum. So we just wanted to share helpful tips out there, and we'll continue to put more of these things out there. But, if you're looking at a packet on a deal, a pitch deck, offering memorandum, whatever it's called, for that specific deal, this is helpful to look at. A lot of times it may not be in the packet, but a sponsor will have it and be happy to provide it for you. So, and then we're happy to walk through this in real time. We do it with investors quite often. They may have some different scenarios. Well, what if this happens or that happens? And we'll walk through it with you. So hope this was helpful. And if anyone has any questions, feel free to reach out to us. But if you're not seeing these in your deals, I would definitely ask for them. They are extremely helpful. So we'll talk to you all next time. Again, if you have questions, feel free to reach out.